Bond dealers are actually usually dealers. They will hold some inventory, they'll hold bonds. If you want to buy, I'll sell you some of my bonds and then I'm going to try to buy from somewhere else. Or if you want to sell to me, I'll buy them and then I'll try maybe tomorrow, maybe after 3 months to sell them to somebody else. And if I can't really sell them, I still have the bonds. I'm still earning money on them. It's not like I'm losing money. So, bond dealers are dealers who specialize in trading various bonds. So you may have corporate bond dealers, municipal bond dealers, or treasury bond dealers. Usually, bond dealers will be a whole company, and there will be a department for treasury bonds and municipal bonds, and of course, corporate bonds. And this completes exactly the section 1, which is on treasuries. Next time, we continue with municipals. Question?
If we want to hold a bond for some time, how do we calculate the price to sell if we want to sell that bond?
How do you calculate the price?
Yes.
You calculate the price based on the yield. But again, sometimes it's a little tricky because that's not exactly how it works. The price of a bond is like the price of a water. What is the supply and what is the demand? And the price is determined only by supply and demand. If there are a lot of investors, they will offer higher price. So the price of a bond is not calculated. The price of a bond is determined like the price of gold, like the price of coffee, like the price of houses, like the price of anything in this economy, which is demand and supply. Now, based on the price, you can calculate the yield. What will be the percentage return on that particular bond? Okay? And you can calculate the yield to be 3.7. Okay? So, that's how it actually works. The price is simply whatever the market will pay, determined by supply. Prices are not calculated. Okay? Now there may be a bid which gives you the yield. If the price is quoted in yield, you will have to calculate the price from the yield. So, depends on how the price is given. Is it given in dollars or is it given as a yield, 3.72%? If it's 3.72%, you have standard formulas. You can use Excel, you can use financial calculators. Your financial management course or other courses will teach you how to do the calculation on a bond of which has, let's say, 3 years and 17 days and yields so much and pays semi-annual and whatnot. But that's what financial calculators do. You just tell it what days to date, what is the maturity date, what is the yield, the semi-annual payment, the coupon rate, then it says, oh, price so much. That's the easiest thing in the world. When you graduate from college and they assume that you don't know anything about finance, they give you the calculation of bond prices. Because it takes Excel. All you do is plug in the numbers, or a financial calculator, or a computer program. So it's something that you don't need to learn much about. Or you can learn maybe in a couple of hours. You need to understand those little tricks like dirty and clean price and yields and risks that are a lot more important. Let's see, more questions because you guys maybe want to go, right? Okay.